for today's session, we're mostly just going to be going through the audit and accounting side of things. And then I also have the regulatory developments also listed on here, but there's just a couple of key points that I want to hit when we get there, as far as how it's going to affect audits potentially. But as Josh was saying, we do have a full regulatory update in our second session on employee benefit plans this summer. Okay, so first, for the audit update, I wanted to start with SAS 136. So I've gone to the AICPA's annual conference on employee benefit plans and the auditing and accounting standards surrounding employee benefit plans. And one of the things that they've kind of been throwing out there a lot in the last several years was potential changes to the reporting standards for employee benefit plans. Almost, they would have somebody from the DOL come out, it almost felt like they were threatening us with new reporting standards. But basically, there had been a lot of just talk on, are these limited scope audits that we've been performing in the past, good enough for, regulatory standards and, from their perspective. And so with SAS 136, there is, which was initially effective for calendar year end 2020. It's been deferred for 1 year with COVID, but we'll get into that a little bit later. But so as far as SAS 136, this surrounds the reporting requirements and forming an opinion over employee benefit plans that are subject to ERISA. So with that, there's a couple of terminology changes that have happened. So I think the main, the most common employee benefit plan audit that used to happen was what was called a DOL limited scope engagement, where we were essentially just relying on certified information from the record keeper and performing a compliance audit over the plan document. And that is now going to be called an ERISA Section 103A3C. So it's kind of a mouthful, but what was formerly a limited scope audit is now an ERISA Section 103 audit. And then an ERISA non-Section 103 audit is going to be a full scope audit. And so full scope audits are less common in the employee benefit plan world. The ones that commonly fall under that category would be health and welfare plans or defined benefit plans, things like that can't necessarily rely on a certification from a trust company or a similar entity. And so with these new reporting standards, there are some additional requirements for us as auditors during the course of these audits. And so, a couple of those things are engagement, acceptance, and potential additional management representations are going to be needed at the end. And then for our risk assessment procedures, and for testing related to plan provisions, we are going to have some additional steps that we're going to have to go through on our end. And there's a requirement to obtain a substantially complete Form 5500 prior to dating the auditor's report. And so I know for us personally, we normally get a full draft of the 5500, and we've been looking at that in the past, but I think the focus has been on Schedule H and the financial information and the accountant's opinion section and kind of going through just, Schedule H. But now, we've always looked at the full tax return, but making sure that we have a substantially complete Form 5500. I know sometimes just to get the audit going, we'll just request Schedule H if that's available, just to make things easier and get things going. But before we date the report, we'll need that full tax document. With those, we've always had to reconcile our report to those, so nothing too exciting there. And then just additional required communications to management as a result of this new reporting standard. And then as far as the entities that are covered under SAS 136, so it's going to be all plans that are subject to ERISA that require an audit, and that's regardless of the scope. So like I was mentioning a couple slides before, there's still going to be what was considered a limited scope audit in the past and the full scope audit. They're just kind of called a different thing now. And whether you're a single employer or multi-employer, and then some of the different types of benefit plans that would still be covered under this. So 401k and 403b, which are the common limited scope audits that we would have been doing in the past. And then when it comes to pension or other DB plans and health and welfare plans, if those are subject to ERISA, they're going to be falling under these standards as well. For entities not covered, that's going to be consistent with the past. So church plans and government plans were not subject to ERISA in the past, and that's still the same case under the new 136 standard. So then for Section 103 audits, the new limited scope audits, as far as the investments are concerned, just wanted to talk about, kind of what we're going to be looking at as auditors and maybe some of the other requirements under this new audit reporting standard. And so first, just talking about the evidence of the nature of the investments. So, consistent with the past, we've made inquiries with the plan sponsor, the investment advisor, or the custodian of the plan on the investment, since they are the ones, holding the assets. And then as far as, making sure that we can reconcile the classifications within Schedule D and Schedule H of the 5500, as I mentioned, a lot of the focus has always been on Schedule H because that's what's going to reconcile to our financial statements. But then Schedule D is what the additional schedule that you file when you have investments in master trusts, common collective trusts, and other pooled separate accounts. And then when it comes to just the nature of investments, typically the service provider will have audit guides or other literature available. But with that said, there's a lot of different service providers out there, and no two are alike. And as far as the audit guide or the other literature that they provide, it may vary from plan to plan. And I know a lot of the times we're given direct access to the record keeper's website, and when we go in there, a lot of the times we can find these documents, but sometimes you have to request that, and so it kind of just varies from record keeper to record keeper, but a lot of times things like that are available from them. And then also an investment prospectus for the different funds. So again, this kind of varies from record keeper to record keeper, but a lot of times when you go log on to your record keeper's website, you can drill down into any given investment that you have in the plan, and you can find the prospectus information, which is going to go into detail, the nature of the fund, what type of a fund is, all of their requirements and things like that. But sometimes, maybe if it's a smaller record keeper, you may have to request that, and it might not just be available online. And then another thing to note is that, ticker symbols on the certified reports don't always indicate that the investment is a mutual fund. I've seen this before where it may have a column where it says ticker, but if one way to look at that is just do a quick Google search, and if you can find information on that mutual fund online, it's probably a mutual fund. But if you can't find anything with a quick search with the 5 letter ticker, then it's it could potentially be something else. And so that comes into with what type of entity is certifying the information. We'll talk about that in a little bit. And then support for the disclosures for investments. And so this is still pretty much the same as it was in the past. So we're not under, this new Section 103 audit. It's going to be certified by your trust company or your bank or insurance company, whoever it may be. But the fair value determination of those assets is ultimately up to management. And a lot of times with those record keepers, they're able to provide a lot of guidance to management as far as what the fair value determination is, and they have a lot of information, so that's what they're in the business of doing. And then support for the investment types and the related classification and footnote disclosures. On that end, the classification as far as level 1, 2, and 3, and a lot of the footnote disclosures, those are still the same, but from our end as the auditors, we still need to be able to support that information that's going into the financial statements. And then support on whether contracts are a FBRIC, which is a fully benefit responsive insurance contract. And so with that new investment reporting standard that came out a couple of years ago, contracts that are considered fully benefit responsive are no longer reported at fair value. They're reported at contract value, but we would still need support for that. And then there's a lot of disclosure that kind of goes along with that in your financial statements. And then for investments, being able to determine whether or not they have readily determinable fair value, or NAV as a practical expedient. And that NAV as a practical expedient was one of those new provisions that came out in that last big pronouncement. Most commonly, your investments that would have been falling under that level 2 category are probably now considered NAV as a practical expedient, but nothing really new there. And then, as I said, a lot of this information is going to be obtained from your TPA or your custodian. I feel like it's been getting better and better as far as providing support on ASC 820 and it coming from the TPAs. I know certain providers out there like Fidelity or Principal do a very good job of giving us all that information that we need, so we can get everything that we need for your disclosures. And then restrictions, unfunded commitments, and investment objectives. So the unfunded commitments kind of goes hand in hand with those investments that are NAV as a practical expedient. And there have been some edits on those requirements as far as the disclosures are required. And I'll get into that a little bit when I get to the accounting update portion of this. But then for the investments, the prospectus or the actual investment fund audited financial statements, these aren't always available online, but typically when you ask your TPA for it, they'll provide it for you on the fund financial statements. Typically, we'll look at those fund financial statements on the common collective trust type investments and things like that when it comes to helping to determine, how they should be disclosed and where they fall into your financial statements. And then for the investment certification, so it's going to be, very similar to what the certifications looked like in the past. And as far as the institutions that are able to provide those certifications. And one thing to note is that certain institutions can only certify certain types of investments. So a bank or a trust company certify mutual funds, common collective trusts, common stocks, and other publicly traded securities. And then an insurance company would be needed when you have pooled separate accounts, annuities, guaranteed insurance contracts, those sorts of investments. And one thing that I have seen in the past is, for example, Great West is an example where there's Great West Trust Company that's going to be certifying certain information, and Great West Life Insurance Company that's going to be certifying other information. And if you look at the footnotes on one of their certifications, it kind of lays out, if you have an investment in mutual funds, it's going to be certified by this entity, or if it's an insurance contract, it's going to be certified by this entity. They do a pretty good job of having those footnotes and kind of breaking down who's actually doing the certification on those assets. And then as far as management's responsibility for ensuring that the certification is appropriate, just look for the consistency of classification within the certifying entity in the Form 5500. So again, when you're looking at Schedule H and Schedule D and things like that, on Schedule H, your investments are broken down between, like mutual funds and common collective trusts and insurance contracts and things like that, making sure that, what's getting reported on the tax return is consistent with the entity that's certifying the information. And then for pooled separate accounts, these typically, you'll see that they have a name that's similar to a mutual fund. So you may do a quick glance at it and say, oh, that's a mutual fund, so it's going to be here. But those would go in a separate spot. And you would know if you had PSAs if your custodian was an insurance company. So if you don't have an insurance company, then that's probably not the case. And as mentioned, dummy ticker symbols and QSIPs. So sometimes they may list out some sort of a ticker symbol, but then if you actually do a quick search on it, that might not be the case. And then, at the bottom there, when in doubt, just inquire of the certifying entity. They, may have information available that's not, just readily available logging onto their website. And then when reading the certification, so a lot of these things are going to be pretty similar to the prior years. You're still going to look for that it says that the certification is complete and accurate, that the signer is an authorized signer within that company, that their title is included, that it applies to the right plan and the right period under audit. And surprisingly enough, we have seen certifications where the wrong plan is listed, or maybe there was some kind of typo in the time period that the certification was for, where I saw one last year where the certification was for an off year end that was supposed to be April 30th, but then they provided it as of April 1st. So we had to go back and get that, and whether there are any exclusions from from your certification. So sometimes certain plan assets may not be included in that certification, whether it's an insurance product related item, or sometimes participant loans are included in that certification. So just looking out for things like that. And then sort of the last section when it comes to auditing for the current year is just some considerations under COVID-19. One of the things that we've been looking at on all audits, not just our employee benefit plan audits, is considerations concerning internal control. A lot of companies changed just how their workforce environment is in general. They went to remote or partial in office and out of office, and changing schedules and things like that. So making sure that, from our perspective, that we're going to evaluate, whether there are any changes, and, whether we have any recommendations under those new environments. And then, as I mentioned, there, is a potential for, breakdown in internal controls, whether, certain controls are now being circumvented because of everybody's working at home and you can't have somebody, physically sign a document. And so if you are going to a completely remote environment, have you kind of gone through and reevaluated some of your controls, and, just making sure that if you had a very, physical paper-based process for, processing things related to your plan, whether, changes for participants or things like that. I know that's not usually the case this day and age, where most plans have gone to a completely virtual environment when it comes to processing participant information. Maybe it's on the side of, processing payroll and, actually getting the contributions into the plan, looking at those things. And so from our perspective, we might look at, two different sets of controls for your plan during the year, because you'll have your pre-pandemic controls and then those that may have been in place once, the pandemic and remote working became more common. And then with COVID-19, just operational issues that could come up for the plan. And so when we do have our regulatory update, they'll go through in a lot more detail as far as distributions and loans and some of those provisions that came out surrounding COVID-19, and some of those changes and relief that was available to participants. So I know loans, for example, it's typically 50% of your vested balance, or $50,000 was like the general sort of limitation on loans, and that's been expanded under some guidance that's been issued surrounding COVID. And then, with COVID, making sure that, any new payroll codes are considered when just thinking about operational issues for the plan, and then also considering, furloughs or employee layoffs and things like that. And then there was some relief that was issued by the DOL under disaster relief known as 2020-01. And I'll go through that in a little more detail towards the back half of this presentation. As mentioned, management representations, there may be some additional management representations that are required as a result of the current year. And the example with that is that if certain provisions from the Secure Act or the CARES Act were implemented for your plan, but your plan document wasn't amended for these provisions, which isn't required, as you can see, until December 31st of 2022, that we might, throw a management representation on there saying that, that the amendments will be made, by that time period. And then partial plan termination. So this has always been a thing for employee benefit plans, but I think the thing to consider is that with that initial outbreak in March of the pandemic, did you have furloughed employees or turnover or layoffs or things like that? And considering whether a partial plan termination may have occurred. And when you have a partial plan termination, the affected employees become fully vested in their benefits. So, definitely something to consider. And so the established rule on a partial plan termination is when it's 20% or greater of your workforce. And so, as you can see kind of at the bottom here, that if you think that you might be teetering on the edge of, having a partial plan termination, that you should probably consult with ERISA legal counsel, which we will have in our second session an ERISA attorney that will, speak to some of these potential issues. And if you do have any specific questions, you can, attend that session and, ask those specific questions. Now, for the second part of the presentation, just to go through some of the accounting updates related to employee benefit plans. So these are the two main ones that I have listed here. So there's ASU 2018-13 fair value measurement, which amends and clarifies and deletes some of the disclosure requirements from that previous ASU that came out that kind of changed, investment contracts and common collective trusts, the other pronouncement that I've been alluding to earlier in this presentation. And then the second one, mortality improvement scales and static mortality tables. So for that, I won't spend too much time on that. That mainly relates to your defined benefit plans that have to report their, future benefit obligations and that are involved with, actuary calculations, which is kind of outside of the norm of employee benefit plans these days, because a lot of those old school pension plans just, don't exist anymore, and no new companies don't implement those. So I'll just touch on that a little bit. So with ASU 2018-13, so there were some changes to disclosure requirements. And so there were some modifications to ASC 820. There were some parts that were eliminated, some parts were amended, and there were some additions to the disclosure requirements. And this applies to all entities, and this was effective for reporting periods beginning after December 15th, 2019. So that would be your calendar year 2020. So as far as the eliminated disclosures are concerned under this new pronouncement, so the amount of and reasons for transfers between levels 1 and 2. So with this isn't that common with employee benefit plans. So this doesn't mean that you had an investment in a level 1 investment, you sold it, and now you purchased a level 2 investment. So this would be, you reported something as a level 1 investment last year, and then Now you're reporting it as level 2 in the current year, and you would need to disclose, why you were transferring it between level 1 and 2, and then your policy for the timing of transfer between the various levels. And then the valuation processes for level 3 investments. So again, I feel like for employee benefit plans, the most common level 3 investments that you used to see were the insurance contracts, but now most of the times those are being reported at contract value. So it's not really an issue for employee benefit plans. It's not very common to see a level 3 investment, at least for the plans that I audit and the smaller plans. Maybe if you have an investment in real estate or something unique like that, maybe it would be classified as level 3, but for the most part, with your mutual funds, your common collective trusts, your pooled separate accounts, those are going to be in levels 1 or 2, or probably NAV as a practical expedient. So again, this disclosure probably wasn't something that was really affecting your financial statements anyway. And then for non-public entities, changes in unrealized gains and losses for the period included in earnings for recurring level 3 fair value measurements. And so we'll get to that a little bit more on the next slide. So for the amended disclosures, for non-public entities, you need to disclose the purchases and sales and transfers into and out of level 3 instead of having that traditional level 3 roll forward. But again, the most common level 3 roll forward I was seeing on employee benefit plan financial statements were those for insurance contracts, but then that's kind of gone away the last couple of years, so not very common anymore. And then for investments measured at NAV, only need to disclose the timing of liquidation and the lapse of restrictions if known. So if you had most of your investments in common and collective trusts, you may have had a table kind of listing out each investment and going through some of these required disclosures for NAV as a practical expedient. And so that kind of simplifies that a little bit. And then information about the uncertainty in measurements as of the reporting date. So that's a new sort of amendment to these reporting standards. The new disclosures, I won't go over this in great detail because this only applies to 11K. So that would be a public company that has a benefit plan that's required to be filed with the SEC on Form 11K. But again, it relates to level 3 investments. And honestly, those aren't very common with employee benefit plans these days. So don't need to spend too much time talking about that. And then finally, there's this mortality, the mortality improvement scales. And so ASC 715 and 960 really relate to defined benefit plans. And as I was saying, those just aren't as common these days. And so, with that, when you have a benefit obligation, so if you have a pension plan, you're basically projecting what your benefit obligation that you're going to pay out to participants under your pension plan are going to be. And so that requires, an actuary to come in and do a calculation of employees in the plan and, essentially how long they're going to live. So that's what these mortality tables are used for. And then, there's just some other assumptions that go into their calculations. And there's certain tables and things like that they use to come up with their calculations. And those get updated on a periodic basis. And so some of the things to consider, if there was a new scale that was out, was it used? And if not, do you have documentation as to why that new scale was not used? I did run into on the corporate audit side where the company had a defined benefit plan. There was a new mortality rate table, but their actuary didn't use it. So essentially we just kind of inquired with the actuary as to why they weren't using that new table. And, there was a reasonable reason why they hadn't updated that, but these aren't very common these days, but just something to consider. And then finally, the last section here is the regulatory update. Sorry about that. So like I said, there is going to be a full session that kind of does a deep dive on a lot of these updates that are out there, but there were a couple of things that I wanted to get into specifically related to employee benefit plans. So I'll go through that now as far as the audit process is concerned. So as you can see, and as I mentioned at the top of the meeting, there were a lot of regulatory and legislative updates around employee benefit plans or affecting employee benefit plans maybe indirectly. So there's the Secure Act, and that was the Setting Every Community Up for Retirement Enhancement Act. The CARES Act had certain provisions affecting benefit plans. And then the DOL Disaster Relief Notice. So this, kind of goes into loans, distributions, and late remittances under COVID. There was IRS Notice 2020-51. And so then that was guidance on the waiver for 2020 required minimum distributions. And then there was IRS Notice 2020-61, which kind of relates to defined benefit plans. So not that common, but it's out there. The Consolidated Appropriations Act. So this kind of goes into the partial plan termination relief. And, I mentioned partial plan termination and considering that in the current year. And then finally, one of the last things that I wanted to talk about was just the Form 5500 and some changes on Schedule H, specifically related to SAS 136 and those new reporting standards. So first, the one thing that I kind of wanted to go into a little bit of detail as far as these regulatory updates are concerned from the audit perspective was this Disaster Relief Notice 2020-01, specifically the section that talks about participant contributions and loan repayments. So this slide here kind of goes over what everyone knows to be the traditional rules on participant contributions and the amount of time that you should be remitting those to the plan. And I know at the bottom here in this last sentence, it discusses no later than the 15th business day of the month following the month in which the amounts were paid to or withheld by the employer. And so that was kind of the old, hard and fast rule that, people would use for remitting funds to the plan. But if, you've been through a 401k audit or a benefit plan audit, we really don't use that 15 days as a benchmark with, plans remitting employee contributions on an electronic basis. It's really as soon as administratively possible. And so when we go through our audits, we'll look at, every single payroll deposit and test the timing on how long it takes to get to the plan. And then, if you've established an average that is, 5 days or lower, if you have, certain deposits that are taking 10 days or 12 days or things like that, our recommendation to our clients has been to report those as late and to calculate lost earnings on those, which, doesn't usually amount to much in the calculation, but we just think that's, the conservative approach to take with, contributing participants' money to the plan. And the DOL, if they were to come in and audit your plan, they're going to look at it with the same sort of a mindset that if you've shown that you can deposit money into a plan in 3 days and wire it over, then you really shouldn't have, certain payroll dates taking, 10 days to get there or something like that. So that's kind of just in general what the rules were. But then with this disaster relief notice, so because of COVID and, a lot of companies going into a remote work setting and things like that, they did offer this relief. And this was kind of coming from that notice. So then, as you can see, so for the timeframes beginning on March 1st, 2020 and ending on the 60th day following the announced end of the national emergency, the department will solely on the basis of a failure attributable to the COVID-19 outbreak take enforcement action with respect to a temporary delay in forwarding such payments or contributions to the plan. Employers and service providers must act reasonably and in the interest of employees to comply as soon as administratively and as soon as administratively practicable under the circumstances. So when that first came out, there was, obviously it was good that there's some relief out there available for, companies that may have had some initial troubles, during that initial sort of time period. And so basically going back to that sentence, solely on the basis of a failure attributable to the COVID-19 outbreak. So if there was an instance, so directly attributable to the COVID-19 outbreak that resulted in a late deposit, that they would not take enforcement action as a result. And so that kind of caused some, confusion and resulted in some debate as far as, what does this mean for plans in 2020 that has late contributions? And so during the national AICPA Employee Benefit Plan Conference and BDO, which we're an alliance firm with, they had a phone call with the DOL because the DOL was at that conference. And apparently when they were asked about this, there was, more confusion as far as, what the rule is and how to apply this disaster relief notice for employee benefit plans for 2021, or for 2020 and late contributions. And so on a phone call, the DOL did provide a clarification. So if the reason for the untimely remittance was related to COVID and such reason is reasonable, then those remittances are not to be reported on Form 5500, nor would lost earnings and excise tax be paid. So what this is kind of meaning is that if you were to run into a circumstance that was COVID related, that was kind of outside of your normal cycle of, how long it takes you to deposit employee money, that you wouldn't have to report it as late with lost earnings and pay excise tax on that. But then, however, they kind of went on to say that that the client should have documentation about the specific COVID reason resulting in the delayed remittance, and that this disaster relief notice isn't to be used for all instances of late remittances during the year if they weren't COVID related. So if it happens to be that, somebody went on vacation and didn't remit it, that's not covered under this notice. And even if you end up going past that 15 business day rule that I mentioned, that those should still be considered late, and that you should still calculate lost earnings and report that as the normal regulations state. So I think initially, we saw a little bit of difference in interpretation on this rule, but this is kind of what we're going with. And so, maybe if you had a couple of instances where you had late deposits, working with your TPA to, calculate lost earnings or get their opinion on it, because, it's potentially going to be an issue when we start to go in and, work on these audits for 2020. So just something to consider. And then for the Form 5500, there's just a couple of changes to the document that I'll just go over right now. So under the new SAS 136 rule, so there's this is the non-section 103. So this is what formerly would have been called a full scope audit. And so the 2020 Form 5500 has been updated for this change, and Schedule H Part 3 is where you'll see that. So Schedule H is where the financial information goes, and then Part 3 is where our accountant's opinion information goes into when we are performing an audit on your plan. And so even though there kind of was a delay in the actual implementation, we're going ahead and just adopting this for our plans in 2020. And so if you were to have a full scope audit, you can see I have the screen grab from the new version of the Form 5500. On question 3A, you would mark box 1 as an unmodified opinion, which on a full scope, would have been the case anyway. And then for Part B, it's going to be that box 3 marked red there, neither DOL regulation 2520, 1038, or 10312. So that's on a full scope audit, and that's what those are the boxes you're going to check on, your Form 5500 now. And so then just really quick, an unmodified opinion is issued when we conclude that the financial statements are presented fairly in all material respects in accordance with the applicable financial reporting framework, which for benefit plans is generally GAAP. Sometimes another basis is used. I've seen modified cash basis used on a health and welfare plan before, but just know that I ran into an issue where a plan was reporting on the modified cash basis, but there are still certain required disclosures that need to go into your plan on a health and welfare plan, even if you are on a modified cash basis. So even though that's out there, just know that if you thought making a switch would make your financial statements easier or something like that, there's still disclosure and work that goes into it. So it wouldn't necessarily, change anything for you. And then for the new limited scope audits or an ERISA Section 103 audit, so there's going to be 2 versions that you can check. So in part 3, answer 3A, it's now going to be unmodified, where previously we would have been checking a disclaimer of opinion. And then for your general 401k or 403b plan, in part B, you're going to be checking box number 1, and that's for regulation 2520-1038. Part 2 on section B is less common, and you're probably not going to see that, so probably don't even need to worry about it. If you just have a general 401k plan or 403b plan, it's going to be 3A1 unmodified and B1 for section 2520-1038. And then down in section C for our EIN and name, that's going to be the same for us Harris CPAs. Our information goes there if we're auditing your plan. And so then here, this kind of breaks down those 2 different boxes for the limited scope audit. So for 103.8, that the audit doesn't need to extend to the statements or information regarding assets held by a bank or similar institution or the insurance carrier that is regulated and supervised and subject to periodic examination. So basically what they're referring to is that the entity that's certifying your information is, subject to review by some other sort of agency. So therefore, that's why it's okay that they're providing that certification. And then down in 103-12, that's where it talks about that second box that's usually not going to be checked, but this would be an audit of an employee benefit plan that does not need to extend to the investments in a pooled investment fund that files a separate audited Form 5500. And so that's just not a common occurrence. So you're probably, not going to see that one very often. Okay, so kind of flew through that pretty fast. I think I saw in the chat that there were a couple of questions. Is that right, Tara?
I don't have any questions yet. I was putting a message out there to let people know they could send it directly to me, but feel free to add any questions you might have into that chat window.